Regarding having control cache and having internal control procedures for the cache. Of course, you can have various funds like petty cache fund. You can have various internal procedures, segregation of duties, and so on. But the easiest way to control the cache is to have bank account, to involve bank as a third party. So first of all, if you have bank account, you don't need to have so much cash on hand, and therefore there is a possibility that you can also have no internal control cache because bank will all you can use the bank in this when it may happen that there is a time lag. So, for example, you put the bank deposit, send the envelope with cash to the bank, for example, tonight, but it will be recorded by the bank tomorrow. So there will be time gap, time discrepancy, and it will be responsible for differences in your balances per books and balances per bank. We'll talk about it in a moment. And, when you have bank account, you may involve checks, and when we talked about accounts receivable, we determined who is the maker, who is the payee in the check. So the maker is the company, the person who is supposed to pay using the check, and payee is the company who is supposed to receive the money. And if you have a bank account, then you will have bank statements. So the bank statements will show all the information regarding checks paid and canceled checks. It will also include information about your deposits and other credits made to your account, and it will report, of course, the account balance after each transaction, after each day of the transaction. So, bank memorandum. Bank memorandum is a document that bank gives to you, and it states the amount of your account balance, whether it increased or decreased. Increases are bigger than decreases, and so on. So debit memorandum. So debit memorandum, the bank will include a monthly fee for bank services. So of course, big banks are each check transferring you pay for it, and the bank will transfer from your deposit. The check will bounce because there is sufficient funds in the account, and so the money that the non-sufficient for the non-sufficient fund check be subtracted from a bank account as well. So what does it mean? No sufficient funds. So the company provides service. Company. Scott company sends the check to Laird company. Then Laird company will take this check and go to its bank. The bank will try to get money from Scott company and will discover that Scott company has insufficient funds. So therefore, the bank will mark the check as NSF, having no sufficient funds, and will return it to Laird. And the bank account of Laird company will be subtracted. The value will be because bank tried to cash a check, was not successful, so lost time and some money, and so therefore some value would be subtracted from the bank account, not from bank.